Right now, as we watch the ticker tape scroll by on this Wednesday, December 3rd, Tilray Brands Inc. is taking a significant hit, trading at exactly 7.28 USD. That is a sharp, painful drop of 0.43 USD, or roughly 5.59% in the red for the session. If you are staring at your portfolio on your phone, seeing that deep red percentage probably creates a visceral reaction. It is the kind of price action that tests your conviction and makes you question the entire thesis. The immediate expectation when you see a drop of this magnitude is that something is fundamentally broken, that the cannabis trade is dead, that regulatory hopes have been dashed yet again, or that the company is burning cash faster than it can print it. The market is screaming sell with every downtick. But here is the reality that the panic sellers are missing. This volatility is the price of admission for what is essentially a massive, coiled spring of geopolitical and sectoral optionality. What we are seeing today isn't necessarily a broken company, it is a repricing of patience. The curiosity loop you need to engage with isn't about why it is down today, it is about what Tilray is building while everyone else is looking at the legislative deadlock in Washington. We are witnessing the separation of the pure-play pot stocks from the diversified consumer packaged goods CPG giants of tomorrow, and Tilray is aggressively trying to be the latter. When we analyze the intraday movement, that 5.59% drop is heavy, no doubt about it. It signifies a flush of weak hands. We are seeing volume spikes on the sell side that suggest retail capitulation. Investors who bought in hoping for a quick pop on a rumor are bailing out as the reality of a slow-moving Senate sets in. But if you look deeper at the order flow, specifically through the lens of institutional accumulation, the picture gets murkier and more interesting. While the retail crowd on the Robinhood app might be hitting the panic button, we are seeing signs of absorption at these lower levels. The smart money, the types who manage risk through Fidelity investments or use complex hedging strategies on interactive brokers' trading platforms, are likely stepping in to harvest these shares. They understand that Tilray's valuation is starting to approach levels where the tangible assets, the breweries, the distribution networks, the medical cannabis facilities in Europe, provide a floor that the market is currently ignoring. The common ground belief for Tilray is that it is strictly a political stock. The narrative goes, if the U.S. government legalizes cannabis, Tilray goes to the moon. If they don't, Tilray goes to zero. That is the expectation. It's a binary bet. But the reality is that Irwin Simon, the CEO, has spent the last 2 years furiously working to decouple the company's survival from the whims of American politicians. By acquiring craft beer brands like Sweetwater, Montauk, and Alpine, Tilray has effectively hedged its own core business. They are no longer just waiting for a bill to pass, they are selling beer, collecting revenue, and building a distribution footprint that they can eventually slide cannabis beverages into the moment it becomes legal. This is the strategy that the market is discounting today. They're looking at the cannabis headwinds and ignoring the alcohol tailwinds. Let's discuss the specific trading dynamics we are seeing. The stock is correlating heavily with the broader high-beta sector today, moving in sympathy with other speculative assets, yet lagging behind the mega-cap tech names like Tesla stock or Nvidia stock, which often suck all the oxygen out of the room. When tech rallies, liquidity often drains from the small-cap and mid-cap growth sectors, leaving companies like Tilray exposed. This rotation is painful, but it is mechanical. It is not an indictment of the business model, it is a function of fund flows. If you are using SoFi Invest or checking your Schwab Intelligent portfolios, you might notice that the algorithms often dump risk-on assets like Tilray when the 10-year Treasury yield ticks up or when there is macro uncertainty. Understanding this mechanical selling helps you keep a cool head. You aren't fighting a fundamental collapse, you are fighting a liquidity tide. The business model itself is where the tension between expectation and reality is most acute. The expectation is that Tilray is burning cash on grow houses that nobody needs. The reality is that they have become the #1 cannabis operator in Canada by market share and the #1 craft brewer in the Pacific Northwest of the U.S. This duality is rare. Most cannabis companies are one-trick ponies. Tilray is a hybrid. They are using the cash flow from the alcohol division to fund the capex of the cannabis division. This allows them to keep the lights on and the R&D running without diluting shareholders as aggressively as their competitors like Aurora or Canopy Growth. While those competitors are shrinking, Tilray is acquiring. The Hexo acquisition, for instance, was a masterclass in consolidation. They took out a competitor, absorbed their market share, and identified millions in cost synergies. This is classic roll-up strategy applied to a nascent industry. I want to pause here and ask a question that gets to the heart of the regulatory waiting game. Comment below. Do you think the government will pass legislation in favor of the cannabis industry anytime soon? Or is the Schedule III rescheduling just another false hope? I want to know if you're betting on the politics or the business fundamentals. Continuing with the analysis, we have to talk about the international angle, specifically Germany. The U.S. media focuses entirely on the DEA and the White House. But the reality is that Germany has already moved. The legalization of adult-use cannabis in Germany, or at least the first pillar of it, is a massive catalyst for Tilray because they are one of the few companies with a license to grow and distribute there. They have a facility in Neumünster. While American investors are obsessed with U.S. federal legalization, Tilray is positioning itself to dominate the European market, which is arguably a better, more protected market with higher barriers to entry. This geographic diversification is a safety net. If the U.S. drags its feet for another 5 years, Tilray has the European revenue stream to rely on. This is something you won't hear discussed on generic investing sites that only scrape U.S. headlines. Let's look at the financials. The stock is trading at $7.28, which puts the valuation in a very interesting zone relative to book value. Critics will point to the debt load, which is significant, but the bulls will point to the cash position and the non-core assets that can be liquidated if push comes to shove. The company is not insolvent. They are managing a difficult balance sheet in a high interest rate environment. This is where the distinction between investing and speculating comes in. If you are buying Tilray here, you are speculating that the management team can navigate this debt maturity wall while growing the top line. It's a bet on execution. The self-investing crowd often misses the nuance of debt covenants and refinancing options. Tilray has shown an ability to get creative with its financing, using convertible notes and equity swaps to keep the wolves at bay. The alcohol strategy deserves a deeper look because it is the bridge to the future. By owning the beer brands, Tilray owns the shelf space. In the beverage industry, shelf space is everything. You can't just launch a THC-infused drink and expect grocery stores to carry it. You need relationships with distributors, truckers, and store managers. Tilray is building those relationships right now with IPAs and lagers. The moment they get the green light for THC beverages, they don't have to build a network from scratch. They just swap the kegs. They slide the cannabis seltzer right next to the Sweetwater 420. This is the Trojan horse strategy. The expectation is that they are just a confused conglomerate. The reality is that they are building the rails for the next massive consumer category. Let's pivot to the competitive landscape. You have the Canadian peers, who are mostly struggling to stay listed on major exchanges. You have the U.S. MSOs, who are technically illegal at the federal level and trade on the OTC markets, which makes them harder to buy on platforms like Robinhood Investments or SoFi Active Investing. Tilray has the advantage of being NASDAQ listed. This liquidity premium is real. It means institutions can own it. It means it's included in ETFs. It means it has access to capital markets that the U.S. MSOs do not. This structural advantage allows them to survive longer than their peers. In a war of attrition, the one with the deepest pockets and the best access to capital wins. However, we must address the risks to maintain our authority and honesty. The bearish case is strong. The company is still posting net losses. The synergies from acquisitions often take longer to materialize than promised. The cannabis market in Canada is saturated, leading to price compression. A gram of flower costs significantly less today than it did 3 years ago. This margin compression hurts. If Tilray cannot cut costs faster than prices fall, they will bleed. Furthermore, the alcohol business, while stable, is not high growth. Craft beer is a mature, competitive market. If the economy slows down and people stop buying $15 six-packs, that safety net starts to fray. The stock at $7.28 reflects these very real